Good morning. So Melissa, it's been a crazy last week or two in lending. So let's jump right into what's the heck has been going on.
Completely crazy between the banking mess and the Federal Reserve meeting and all of the just uncertainty about really bank like safety. How strong are the banks? And ultimately, it has not been bad for mortgage rates.
I
They're
saw that.
down a bit, which is so nice.
Yeah, I saw that. Good. Okay. So first of all, what is driving the interest rates to go down a little bit? I mean, you just said a bunch of stuff. So uh, we know that monthly the Feds come out and have their little chat with us. And the banks, uh,
Hmm.
Silicon Valley Bank, I think was one, that kind of shut their doors, right?
They did. Yeah, Silicon Valley and Signature Bank are the two that actually got shut down. And then First Republic Bank is needing or needed some additional government support. But outside, and then of course you had the Credit Suisse issue in Switzerland, which it was different and had been ongoing for a long time. So that really wasn't quite the same thing, but it just happened all at the same time. And
What
so
is going on in Switzerland that's affecting the United States?
they just had that particular bank had been having problems for honestly years, and really problems with how they were run, how they had managed risk, investments they had made. So it wasn't, there was nothing systemic about that bank being on the borderline of failing. It's just from a news cycle standpoint, it happened at the wrong time.
Ah, got it. Okay, got it.
But they were ultimately bought out by UBS, and maybe against UBS's total willingness, but kind of like Bank of America buying Countrywide back in the day.
Yeah. So I mean, over the last several months that we've been talking, repeatedly over and over again, we're seeing how different ways how the rest of the world impacts our lending here, which, we could go deeper into that, but I'm not going to ask you to because we only have a few minutes. But just wanted to point that out that it's repeating itself over in different ways that the rest of the world does affect us. And I'm sure we have the same effect on the rest of the world. So
Yeah, it really does.
okay, so what were some of the other big items?
I think the biggest is just that the Federal Reserve they did do a quarter point increase, which oddly enough resulted in a decrease in mortgage rates. But I think it's the stability of having a feeling like the market has a better hold on what they're doing, and the fact that they have to balance. They can't go completely nuts raising interest rates to just crush inflation. They can't do it because of the fragility in the banking system.
Mhm.
So I think knowing that they're taking a slightly more cautious approach and maybe slightly slower, we think there'll probably be maybe one more quarter point increase this year. And hopefully that's enough to keep inflation down and at the same time keep the banking sector healthy. And as a result, everybody feels more calm about the market, and that has led rates to come down a bit. Um, so that's really what's happened.
Okay, great. So from the lending point of view, what are you seeing are you seeing more buyers coming out right now? What are you seeing from just the pure lending side?
We are definitely more buyers and more qualified buyers. So that's been kind of nice. But the other thing that we're seeing is a tightening of credit. And you're going to see that with particularly the banks that are involved in all types of lending, including mortgage, because of just the overall instability and concerns about balance sheet. They are going to tighten up their lending standards, and we've already seen that a little bit. I think that will be maybe the trend of the next couple of months. So that's something to watch for. Now, we're a mortgage bank. We're not a bank. So we don't have to worry about, we sell direct to Fannie and Freddie. The guidelines are not changing. So that's something that I love. Um, so allows us to shine a little bit more.
Very, very nice. And so really quick, what does tightening of credit mean? Does that mean they're looking at credit? uh,
Yeah, it means they're going to tighten guidelines generally so that they're making less risky decisions.
Got
So
it.
maybe
Makes
it's
sense.
slightly higher credit scores, slightly lower debt ratio requirements, maybe no collections in the last 2 years when someone with a little collection would have been okay. Things like that, that they're just tweaking, or maybe certain property types that are considered riskier, like condominiums, maybe those will get harder to finance. So it's really adding additional underwriting guidelines to the guidelines that are put out by Fannie Mae and Freddie Mac.
Yeah. So as always, credit, if people should always work on their credit, they should always work on paying down debt without using a ton of money out of savings. And save at the same time. It all can be done. We do it every day. It's just making smarter decisions with your money. Anyways, okay. Okay. What else do we need to talk about? Well, first we were just talking again about your buy downs that you guys offer.
Yes.
Let's talk about that really quickly again. I know we talk about week over week, but
No, I think it's a great way for somebody to be able to pay an interest rate, an effective interest rate that's 1% lower or 2% lower than the market rate. So if the market rate is 6.25%, they can pay 5.25% for the first year if they're doing a 1-year buy down, and Guild will pay for that 1-year buy down if the seller's not willing to. And then if they can do a 2-year buy down, then they're at 4.25% for the first year, 5.25% for the second, and then the current market rate for the third year if they haven't been able to refinance. And again, if the seller will participate and pay for the first year, we'll pay for the second year.
very nice. So that's a huge reason why I come to Melissa at Guild Mortgage, is because you guys help buy down that rate for the year or 2 years. I mean, that's phenomenal. Almost, I haven't seen another bank do it. I'm sure there are, but that's great.
No, I love that we do it. And I think that the first year or two that someone lives in a home, they're going to have the highest expenses during that time period because they've got landscaping, they want to do furnishings and new paints, probably a couple new appliances, light fixtures. I mean, the list goes on and how you want to personalize things. And so having a little bit of extra, well, actually, honestly, several $100s extra each month for the first year or two really can make a difference.
Right. And then, down the road or during that time, they can always refinance if the interest rates actually do drop even more, if it makes sense.
Absolutely. And the other cool thing is if they do a 2-year buy down, the money that they got from the seller and or from Guild gets put into an account. If they don't use all of it to subsidize their payment, so they don't go the full 2 years before refinancing, the remaining amount goes to pay down their principal balance when they refinance, so they don't lose it.
Whereas point buy downs is the opposite. If it's not used, then you just lose it. So
right.
Great choice. Buy down the rate instead of buying down the points.
Yeah. And then the other thing that I'm seeing on the lending side is just as the market gets a little bit more competitive and more buyers jump into the market, I think it's going to be more important to get credit approved. So get that done up front. Make sure you are the strongest buyer you can possibly be. Give yourself the peace of mind that knowing that it's already done, and then be able to put in a credit approved offer and be able to close in 17 days, whatever it is, but close quickly.
Yeah, great. And that leads into just really quick, just because you think you can afford a $3,000 or a $2,000 house payment, your credits and your debt to income might say otherwise. So yeah, I always tell all my buyers, get pre-qualified, get pre-approved prior to even looking at a house.
It is so important. And I had a buyer recently who, I mean, they thought they qualified, but in their head, they're qualifying with the total household income. Well, because of the situation, we couldn't use one of the household members' income because they'd recently started a new company. And so ultimately, we could not get them approved for what they wanted. Now, we found another way to do it using a bridge loan, but we had to scramble a little bit, and we wouldn't have had to do that scrambling if they'd gotten us all the documents up front.
Yep. Got it. Perfect. Okay. So get pre-qualified or pre-approved up front when you start even the process at all. Your realtor can absolutely help you do that. And unless you know a good lender, we can get you in touch with Melissa and, okay, well, thank you so much for your time today, Melissa. And looks like the sun is getting ready to come out finally after a ton of rain. So have a great weekend and thank you. I'll talk to you next week.
Yes, you too. Thank you.
Bye.